Joining us from the Manulife Investment Management team is Kevin Headland. Kevin is a Co-Chief Investment Strategist and has a wide range of responsibilities from market and economic analysis to investor education. He analyzes and interprets the economy and the markets on behalf of Manulife and works with the portfolio management teams to provide support to advisors and their clients. Please join me in welcoming Kevin Headland. Kevin?
Thanks so much for everyone for joining me today. Appreciate you having me on the conference. So essentially, as Greg mentioned, my role is really about helping advisors understand what's going on in the world and how things are working. Right now, of course, great timing. We're getting a lot of volatility in the marketplace, having a lot of issues right now in terms of how things are moving, how things are going with the markets, the volatility that's happening. And a lot of it about why things are happening, what's going on in the markets, and what should we be doing about it. One of the things we're seeing right now is obviously a lot of pullback. Most of it is a result of the Federal Reserve announcement coming out today, whether they're going to start raising rates, what they're doing in terms of changing their balance sheet structure. Are they raising rates faster than expected? And that's creating a lot of volatility. The key here, though, is whether investors get rewarded after sell-offs. We're seeing a bounce back today, but if you look at history back to 1970, when we see sell-offs like we have recently, we haven't hit the 10% correction level, but when we get -5 to -10%, especially in non-recessionary periods, which we believe we are in today, and we'll talk about that in a little bit, things are very attractive. The markets 1 year forward are in that 7+% range. And if you roll forward when markets are pulled back even further, over -10, over -15, and over -20, then you actually see even better 1 year performance returns. So we have to understand what the environment is. Are we in a recession or not, and why the market is selling off? In addition, what we see, of course, is this volatility, and we get the VIX index, which measures volatility and which shows the amount of fear that is in the markets right now. And the VIX, when it hits over 30, is a really good buy signal. What we look at here is we look at when the VIX is over 30, under 30, and then all levels. And clearly, once the fear is the strongest or the most fearful levels above 30, 6 months, 1 year, and 2 years forward on an annualized basis, returns are extremely strong. Warren Buffett often says, I want to be greedy when others are fearful and fearful when others are greedy. And what we've seen over the last few days is that fearful level, and we would be saying it's a really good opportunity to be investing in this market. Why do we think that? Because we're seeing right now is positive environment. We're not, I would say, bullish necessarily, but very constructive, very happy about the market. The way we've been characterizing our outlook is essentially a road trip, right? You pack the kids in the car, pack the family in the car, pack your luggage, and we're on a road trip. We have a destination in mind. Things are going great, but we know there's going to be pit stops along the way. We know there's going to be expected and unexpected events. Right now, what we're seeing is one of those quick, unexpected events where we just left the house, we've gone around the corner, and we realize we forgot something. We got to go back to the house. It's a little bit of a step back, but we're still expected to be on our destination. And we use this Brad Paisley quote here. If you make the mistake of looking back too much, you aren't focused enough on the road in front of you. And the key here is we need to know where we've come from, but more importantly, where we're going. We have to keep our eye on that destination with it still the belief of making sure we avoid some of those pit stops as much as possible. When we look at the global backdrop here, this is why we're not necessarily fearful about this market, because the economy and the economic backdrop, the economic fundamentals remain quite attractive. We've used this chart many times over the years. This is probably our favorite chart of our entire chart pack. Usually we have about 70+ charts we can pull from on any given presentation. But this is our global manufacturing purchasing managers index heat map. A lot of words there. It's a mouthful. But essentially what it's trying to do is measure the health of the manufacturing sector. So every month, this company out of the UK, Market, MARKIT, does a monthly survey of manufacturers in countries around the world, and you see them on the left-hand side. That survey is measuring if those manufacturers are in expansion or contraction. And that index level comes out above 50 or below 50. So 50 is your zero line. You want to be above 50 is expansion, below 50 contraction. A lot of numbers here. We have 2 years of data. So we've color coded it. Red is bad, yellow is neutral, green is good. And it's not as specific enough, or it's not as important to look at the individual monthly data. We're trying to look at the trends here. Now go back to pre-COVID. Even before the year turned to 2020, we already saw a lot of yellow in economic data globally. We were already seeing slowdown. We didn't expect COVID to happen, but we were already seeing some weakness in the global economy. Then, of course, we got the COVID shutdown, absolutely red, where governments shut down factories, people couldn't work, manufacturing essentially almost stopped on a dime. Then we get the recovery phase, 2020 and into 2021, a strong expansion post-recession recovery. This is where red goes to yellow, yellow goes to green. Now we're in a phase at the right-hand side where there's a lot of green. Things are very attractive. Now, they might not be as strong as they were at the peak earlier last year or mid last year, but they're still very strong. The important side is, yes, things are a little weaker and data has rolled over, but peak does not mean weak, meaning once it's past peak, we can't maintain the same pace of growth or expansion, but it's still very solid footing. We characterize this environment as the normalization phase. You have the recession, the recovery, the expansion, and then the normalization phase. This is normalization phase where economies are growing, but more normal, less strong, but still solid. And we should expect very solid returns at the equity markets, again, point to point. From our destination in mind, at the end of the year, I think we'll be very happy with the market performance this year. When we look at leading economic indicators, this is another reason why we believe things are very, very attractive from an economic perspective. So the U.S. Conference Board does a monthly publication of an index, and it aggregates 10 sub-indicators to produce an index. And it uses those 10 sub-economic indicators because they've proven over time to lead the economy. It's a very good predictor of whether we're at risk of recession or not. You see those gray bars, those recessions. The green line, the index, is never below zero, or is always below zero during recession. We don't ever see a recession until that green line is negative. Right now, it's past peak, as I said. It's slower, but still very strong. Now we're seeing some kind of stabilization here, still indicating very strong environment. Now, for those of you in Ontario or Quebec, things don't seem that great from an economic perspective, but US and Canada, the economy still is chugging along. The factors are still very strong for the economy. Why is that? Consumption remains strong. We look at the US data here. Mostly our data is US because it's much more robust, has much more information. When we look at the left-hand side chart, we can see the trend of personal consumption, personal income, savings rates. Yes, they've come down, but they're still very strong. The consumer is still healthy. Their personal balance sheets are still very strong. On the right-hand side here, we show the difference between current levels of personal income, consumption, and savings versus the 3-year average pre-COVID. Notice in all instances, except for savings rate, which is slightly below the long-term average, everything's above. So personal income, well above the pre-COVID levels. Personal consumption, also well above. These are good news stories. The economy is roughly 70 to 80% consumption driven. And that's important to understand that if the consumer is in good position, the economy should be in good position. Once again, slower, but not recessionary. Still very strong. Despite any short-term volatility, we're still on the path to our destination. When we look at our equity markets, what are things going on with our equity markets and why we're constructive here? For us, it comes down to earnings. Now, what we're seeing right now is you have the uneasiness around the Fed, but you're also in the midst of earnings season in the US and also starting in Canada for the fourth quarter of last year. What we're seeing is companies that announce good earnings and good guidance or forward looking seem to be being rewarded by the market. And those that miss or announce weaker expectations are being punished. We believe earnings are still solid on a broad-based perspective. It's more likely that this is a stock picking environment where active management outperforms passive or broad index, but the broad index still looks attractive. The left-hand side chart here, we look at our nuts and bolts index versus earnings growth. The nuts and bolts index, that green line, that's a proprietary index we created to aggregate a lot of the manufacturing data together. Manufacturing tends to lead earnings growth directionally. Why is that the case? Well, think about things. If manufacturers are manufacturing more goods because there's more demand, chances are those companies are going to announce more earnings, more profits. That's a directional correlation. So right now you see the green line has peaked and has started to come down, but again, it's starting to trough, it's starting to bottom, it's starting to stabilize. This is why we believe while earnings can't grow at the rate they grew last year, which was near 45%, they can still grow quite easily, likely in the low double digits or mid-teens. This is still attractive for equities. We just have to reduce or readjust our expectations. Do we think we're going to get 20+% returns in the US equity market this year? No, it'd be nice. It's always possible, but our base expectations are more average like. High single digits, low double digits returns with risk the upside. We're going to get choppiness. This is not the end of the choppiness, but again, it's a destination. We still think markets and equity markets are going to be positive and very strong this year. When we go to the right-hand side chart, we use South Korean exports to give us an indication of how earnings are growing globally. South Korea is a very diverse economy. There's a lot of goods that are exported around the world that somehow touch South Korea at some point, especially electronics. If you're buying electronics, chances are it's touched South Korea at some point along the manufacturing chain. Right now, we're seeing on the right-hand side, very strong exports. This is a good news story. Do we think earnings in international equities are going to grow triple digits? Not at all. We're just trying to show you how healthy we believe the environment still is. We still believe things are strong and will remain strong, just a little bit weaker than they were in the expansionary phase of the post-recession recovery. Canada still looks strong as well. Again, we think it's more stock picking. We don't think oil is going to grow or double this year like it did last year, but still very strong. So we use oil here to show the trend in earnings. And that green shaded area on the right-hand side there is an extrapolation through the next 6 months to see if oil is $80 on WTI, what is the year-over-year change in oil prices? And that gives us a good indication of the direction of earnings growth, which is that green line. Not surprising, just like all the other data, we're past peak. We've come down, but now we're stabilizing. And we believe also earnings in Canada will stabilize. They'll be quite strong, not as strong as they were. And oil energy sector, same thing, not as strong as it was. But there's still a lot of attractive companies, a lot of attractive areas that exist in Canada. Less strong than they were, but still very, very attractive, very solid. One of the biggest issues right now, of course, is fixed income. What to do with fixed income? 2021 was a tough year for a lot of fixed income asset classes. A lot of fixed income bond funds ended the year in red. They were negative, which is rare. It's rare to see negative returns. What's even more rare? To see 2 consecutive years of negative returns in fixed income. So we don't believe we're necessarily going to see a negative return again this year. But also we have to understand what fixed income does in a portfolio. We believe in this environment, fixed income should act as an umbrella in your portfolio. It's not about chasing returns. It's about protecting on the downside and using that downside protection perhaps as a source of capital to add to equities should we see short-term, non-fundamental type volatility like we saw recently in the markets. It's also important to understand where you want to go in fixed income. If we go back to the end of December 2020 and looked at our statements to decide where we should invest in fixed income in 2021, well, the best performing fixed income bond funds were plain vanilla, long duration, Dex Universe bond, government bond type products, because they did well protecting during the COVID crisis. But they actually did the worst in 2021 because that's not where we wanted to be. Rates were rising. The yield curve was steepening. We want to be shorter duration, more credit centric, less government bonds. And lo and behold, 2021, credit was the best performing asset class. Now what we see is going forward, maybe credit won't be the best asset class this year from a total return perspective. When we talk about fixed income, we have to talk inflation. This is obviously on the minds of all investors. This is one of the biggest issues we're seeing right now is what to do with inflation. Where's it going? The Fed is going to talk about it today. The Bank of Canada talked about it briefly this morning. We have here is a inflation model. We look to try and anticipate where we think inflation is going. We use things like wages and wage growth, shelter costs, what's moving higher in housing costs. We look at oil prices. What's the direction of oil prices? How much year-over-year change is oil prices? And of course, we look at currency. So again, this is a US model. So we look at the US dollar. When the US dollar is declining, that is indicative of inflationary pressure. Because like Canada, when we import goods at a lower currency, that costs us more in our currency. So we believe that, so that is inflationary. The green line here is actual CPI. Notice it's very high. We hit 7% recently in the US. We're just shy of 5% in Canada. That is higher inflation. But it's not just demand-driven inflation. There's also supply chain disruptions. Those have been longer or lasting longer than expected. A lot of people thought they'd be done by now, but there's still issues to resolve in supply chains. They'll be around for longer, which means that inflation will be around for longer. Right now, the market expects the Fed to raise rates 4, maybe 5 times this year. The Bank of Canada, maybe 5 or 6 times. We would say probably not that many times, but they're still starting to raise rates. They're going to try and combat some of the demand-driven inflation. What I mean by that is they're trying to just reduce some of the extra stimulus or extra support they put in during the pandemic. That was inflationary. That was to help the economy. It's no longer needed. As I said before, the economy is on solid footing. So the Fed and Bank of Canada are just saying, we don't need that extra support. It's time to reduce that support. It's not saying the party's over. It's not saying we're going to raise rates extremely strong, extremely fast and choke off the economy. No, it's just saying we're going to start moving higher towards a normalized level. They're essentially at zero bound right now, interest rates. There's no need for that. So we're going to start moving that higher and try and take some of that inflationary pressure that they added during COVID to help reduce inflation. We still believe the inflationary levels or CPI will remain above target levels. In the US, probably above 4% in the first half of this year, and probably still above 3% through the back half of this year. So still inflationary, but understand that it'll likely come down. That's important to understand. It's a rate of change measure. We believe that things are going to be slowing, still growing, but slowing. Think about it like a balloon letting its air out slowly, right? We're not going to blow up the balloon, but slowly let the air out. That is what we think is going to happen with inflation. A little bit slower, still higher than expected, but not as high. We believe we are likely at or near peak inflation levels. When I talked about the fixed income and the credit environment, this is why we're not so attracted to credit this year. It's not the time to chase returns. We've looked at the spread of high yield bonds in the US and investment grade bonds in the US. And what you do is you look at the spread, and that spread is a measure of the additional yield you get for taking on the additional risk over government treasuries. If you have a corporate credit looking to borrow money from you, well, you should get a better yield than a government bond, right? But here is what we've done is ranked them on a percentile basis. So every month since since 1996, that spread is ranked on a percentile basis. So when you're near the high end, that's when spreads are the widest. That's when you're getting the most additional yield, but also that's indicative of the most risky environments. The key is when spreads come down, that's when the big returns are made. Notice the right-hand side chart there. During COVID, spreads really high, and as they came down during 2020 and 2021, that's when the big returns were made. Right now, they're near 10% levels, meaning that 90% of the time, spreads are wider. So this is a very tight environment. If spreads are near all-time tights or all-time lows, there's not much more room to give returns. Yes, the yields are still attractive, granted. So we want to still own credit. We just got to be mindful of where we want to own credit and what it's going to do for us in our portfolio. It's going to give us a bit better yield, but don't expect the big returns. Again, not the time to chase returns in fixed income. That fixed income should be your downside protection, that umbrella in case of rain when you're unsure. That's what fixed income should be in a portfolio. Smooth out the long-term ride. We've been very fortunate in fixed income over the last few years that we found areas where we could generate outsized returns. That's helped balance funds and help balance portfolios. We have to readjust our expectations. Lower equity returns than we're used to, and also lower fixed income returns than we're used to. That's not necessarily a bad thing. It's just more normal. It's just not as good as it was. It's still very strong, just not as good. And one of the questions we get a lot when we look at our portfolio and our views is our view on the Canadian dollar. What do we think about currency going forward? Again, we have a model for currency. We look at oil prices, of course, as it's we know that the loonie has been considered a petro-loonie for quite some time, and that's the idea here. But what we're seeing also is since the great financial crisis, there's another factor at play, and that's what we call the two-year yield differential. That is the difference between the Canadian government two-year yield and the U.S. Treasury two-year yield. Why is that important? Because it's a measure of the difference in the market's expectation for monetary policy. Meaning, is the Bank of Canada raising rates faster than the Fed, or is the Fed expected to raise rates faster than the Bank of Canada? Right now, the market expects the Bank of Canada to raise rates faster than the Fed. So their two-year yield is a little higher. That puts upside pressure to the Canadian dollar. So you look at our fair value model, that's a blue line. It expects the Canadian dollar to be around 87 cents, 88 cents. We don't think it's going to get there, nor do we believe the Canadian dollar is going to remain where it is today. We believe there's slight upside pressure. Our target is 81 to 83 cents. When we look at a lot of data, especially currency, we try and identify where the balance of risks are. Are they to the upside or downside? And right now, when we look at the Canadian dollar where it is today, based on what we think oil is going to do this year, what we think the two-year yield differential is going to do this year, our model says we're likely going to see upside pressure to the Canadian dollar. So there are more upside risk than downside. Not material, but still we believe Canadian dollar is going to go a little bit higher than where it is today versus downside. There's always going to be short-term volatility, especially when you get risk-off events like we've seen over the last few days. You're going to get a rebound in the US dollar because of the flight to safety. But over the trend, we believe over this year, that trend is going to be higher for the Canadian dollar. So what does our model portfolio look like? Now, for those of you who don't know, our model portfolio is a paper-based portfolio. So we don't manage money, but we do have a model portfolio that is used as a guideline for advisors. If we were to create a portfolio, 60-40 average investor based on their forward views of the market. How do we manage a portfolio? Would we overweight equities or underweight equities? And where would we be invested? So right now, and the way we've been since late 2020 is slightly overweight equities at 65% equities. So we're still more positive on equities than we are fixed income, but we're not taking major bets on equities. We're not really raising our equities given the returns we've had recently. And if you look at our equities, we're fairly evenly spread out geographically speaking. A lot of advisors ask us, where's the best area of the world to be invested in? And I say there's no real obvious place to invest right now. We think it's more of a stock pickers market. We want to identify good businesses. It's about quality. Those good quality businesses that are going to generate good returns are those that are generating good profits and good earnings. Stable, probably boring. This is not the time to chase returns. You can, but I think this environment is where you want to take profits and get a more stable investment in equities. So we've kind of split our equities evenly. US remains our favorite. US has a lot of depth and breadth. So we think US remains very attractive, but still Canada, international, and even emerging markets looks attractive. Emerging markets have had volatility recently, especially last year, but overall things are very attractive. And if you want to avoid having that emerging markets as a line item in your client statements, you can always look for portfolios that look to take advantage of the emerging market dynamics and fundamentals without investing directly in emerging markets. There's a lot of companies out there that benefit from the improvements in the middle class and other areas of the emerging markets without buying companies that are listed as emerging markets. On the fixed income side, we have a 35% fixed income, and what we've done here is actually reduce our high yield weight from 15 to 10. As you saw before, we don't think it's time to chase returns in high yield. We still like it on a relative yield basis, so we don't want to get rid of it altogether. We want to, though, enhance our core bonds. And we're not saying, again, back to long duration fixed income. No, we prefer shorter duration, call it less than 5 years, but also looking at areas around the world that can offer us attractive opportunities. Just like equities are a stock pickers market, we believe fixed income is a bond pickers market. We want to have our portfolio managers to have the most flexibility to provide us with the best returns, but also the best risk management. Remember, right now, we believe fixed income is back to being that risk mitigator in a portfolio, not necessarily a return enhancer. So we're using it as that umbrella. Should we get additional volatility and opportunities to add to equities, we want to protect on the downside. We want to win by not losing. And that will help us compound our growth over time much faster, much stronger. For those of you who want to follow us, by all means, you can check us out on LinkedIn. We have our websites with all our information on our recent notes that we're producing. If you want to get access, please reach out to your Manulife Investment Management representative, your wholesaler, or your wholesaling team. We also have a monthly email that is an add. You have to request to be added, of course, due to the restrictions or regulation across Canada. But reach out to your wholesaler, and we'll definitely add you to our monthly email. You'll have all access to what our thoughts are and where we think things are going within the markets. Now I'll pass it back on to Greg, as I believe my time is up.
Right on time, Kevin. Thank you. And thank you again on behalf of all of us at IDC. That was really informative, and we really appreciate you sharing with us some of the statistics that you had. So thank you again.